welcome to the Ion Influencers Fireside Chats, where we speak to the sharpest minds from the world of capital markets. I'm your host, Giovanni Amodeo, and today with us, we have Dom Wells, who is CEO and Director of Onfolio Holdings. And the talk of the day, the topic will be how to make repeated online digital acquisition. So thank you for being with us, Dom.
Yeah, thank you for having me. I'm really looking forward to it.
Perfect. So Dom, maybe if you can give us your background first, and then we're going to go into Onfolio.
Sure. Yeah. I'm the CEO and founder of Onfolio, and before Onfolio, I've been running and building online businesses for about 12 years now. First started in 2012, and really I just started out as someone looking for ways to make money online, and when I started to find ways, it was through building online businesses. And over time, I realized it was better to start buying businesses than starting new ones. And I basically built up a following of people who wanted to do the same. And that kind of led me to creating Onfolio.
If you can give us a little bit of a background of Onfolio, how big it is and so on.
Yeah, sure. I founded Onfolio in 2018, and basically, the idea was there were a lot of people out there who saw an investment opportunity with online businesses, and where they really struggled was they didn't know how to run those businesses, or they didn't know how to find them and perform due diligence on them. So initially, that's what we did with Onfolio. We just did it as a service provider for individual investors, and over time we pivoted to become a holding company. We raised money into the holding company, and then last year in August 2022 we actually IPO'd on NASDAQ as a way of raising more money and making acquisitions easier and making recruitment easier and fundraising easier as well. So right now we're on track for about 6 million in revenue, planning to increase that significantly with our next few acquisitions, and just rinse and repeat and grow from there.
Perfect. At the beginning, you said you realized quickly that it was easier to buy businesses rather than creating them. What made you realize that, and why is it easier?
Well, I think buying a business is not necessarily easy, but when you start a business from scratch, you don't have product market fit, you don't have any traction. You could throw a lot of money into it, and after a year realize it was the wrong business to go into, or something like that. Whereas if you buy an already established business, you can see many years of operating history. You can see how volatile the earnings are. You can see what the competitive space is like. Is it growing? And essentially, it's just you're just kickstarting. You're skipping the difficult period where a business establishes itself and then taking over from there.
So what do you look into the market? So let's start from the market first. How do you know whether there is a market in the business that you're acquiring? Whether it's a proven model or not, but if there is a market there?
Well, we only buy businesses that are already profitable. So, if it's generating revenue and making profit, then that's a pretty good sign that there's a market. So sometimes the tricky part is knowing, okay, how much can it grow from here? But yeah, we're not buying a business that kind of hasn't really proven itself yet, hasn't really got any product market fit. So yeah, the answer is basically in the P&L already.
Perfect. And my question was more around the size of the market. You said the company, if it's profitable, yes, that's a good indication, but then the size of the market. So how do you know if that market has got potential to expand?
It's a lot of assumptions, a lot of guesswork. Sometimes it's obvious. You can see it's in a very fast growing industry, but other times you don't really know. But I think for us, the real investment case is not necessarily about how much the market can grow, but about how stable and consistent it is, and is it going to stick around for 5 or 10 years? So it's a lot easier to predict still not necessarily easy, but easier to predict. If a business has been operating well for 5 years, is that market going to allow that business to, at the very least, maintain its rankings and its earnings and its momentum? So we're not necessarily trying to get 4 times MOIC in 2 years or something. We're trying to just buy a business and get the stable, consistent cash flow. And so, yeah, sometimes we don't know how big is it, but it's easier to know, okay, is it going to at least stick around for the next few days?
And just give us an example of the assumption that you made when you were about to invest in a business that then ended up being successful. Well, I'm trying to look at your thinking process.
Yeah, I mean, we look at kind of everything, but the first thing we do is we look at the profit and loss statement of the business, because it doesn't tell you everything, but it can tell you very quickly if it's not suitable. Maybe it's got really seasonal earnings, or the earnings are trending down, or you think it's a good business, and then when you actually look at it under the hood, you realize it's got a ton of like kind of financial health issues. And so if reviewing the P&L tells us, okay, yeah, this does look like a good business that we were interested in, then we'll kind of ask ourselves what's missing. Like, okay, is there a full team in here? Is there an operations manager? Is there a general manager? Is the founder doing everything and then they're going to leave after we make an acquisition, or are they going to stay? Or are they more of an owner and there's already like a business manager in there? And then we might look at some of the direct competitors and see what they're doing. Where does this business kind of fit into the ecosystem? Like, is it the market leader? Is it the second place? Where is it? And then we'll do some of the things I talked about with trying to figure out, is this in a growing market or a shrinking market or a stable market? And then there's just a lot of calls in between where we'll speak to the seller of the business and maybe their executive team. And we're really trying to look for flags, I guess, like inconsistencies, anything where maybe their answers contradict themselves, like the kind of obvious things, like if you were doing almost like an interrogation, but also looking for opportunities, looking for things that they've struggled with. A lot of these people we're buying businesses from, they've grown it from scratch, kind of through their passion, and they're maybe not a well-rounded entrepreneur. So we're trying to find out, okay, where are maybe the traumas in their business, or the things that have suffered from this entrepreneur maybe having some blind spots or weaknesses. So have they had bad bookkeeping? That's often something we need to figure out and fix. Maybe their team are not as good as they could be. So it's as much about identifying risks as it is about looking for opportunities and really asking ourselves, are we capable of running this business and hiring someone to run it? And then sometimes it's just, at that point, it's just a financial decision. Like, does the structure make sense? Do they have a realistic expectation, a realistic asking price? Things like that.
How thin can you and your team spread yourself? If you're looking at all these acquisitions, how present can you be in all of them?
Well, yeah, up until January of this year, we were essentially quite centralized and trying to run every business ourselves. And maybe we would have one business owner who was, one manager who was managing, say, 5 or 6 different businesses. And we would think, okay, this is great. We can get economies of scale. We can get operating leverage. And we hire one of these people, maybe they're a bit expensive, but then every time we buy a business, we don't, have to deal with it. And the problem is, like you say, you spread yourselves quite thin doing that. And the cost savings you get end up leading to a loss of focus, maybe declining revenue. That person ends up needing to hire a bunch of people to help them. And so it just doesn't work out as planned. And so January this year, we made the switch to being a lot more decentralized. And so every different business has a dedicated business manager running it, which does mean it's a little bit more expensive in the short term, but the performance of the business is so much better that way. And it means we're able to scale. So then our challenge is just, okay, can we understand these businesses enough to be able to understand how they run and what type of manager we need to hire for them? But yeah, that's a lot easier than trying to run them all yourselves anyway.
Eventually, these businesses will make acquisitions themselves. How will you be able to monitor the acquisition of your acquisition? And again, have you thought of a structure to support that?
Yeah, I think the key thing is understanding that there's a distinction between being a good business operator and being a good acquirer. And so some people can do both, but most people can't. And so really it's going to be something where maybe the acquisition or the subsidiary is perhaps leading the target identification of an acquisition, but then they're getting support from us in doing everything else, like everything I just mentioned, the due diligence, the understanding the numbers, the negotiation and the structuring. But where it really helps is we can't really say to one of our subsidiaries, hey, we've just bought this second business for you, have fun. But what we can do is say, hey, we've identified one that might be good for you, and then let's talk about it and so on. And then likewise, they'll probably identify ones that they think are good, like, hey, can I buy my competitor, or can I buy my supplier? So it could be vertically integrated acquisitions. And that's where we say, like, yeah, okay, let's see if we can afford it, if it makes sense, and all those other things. So it's it's really about us collaborating to lend the real expertise, but them being closer to the business and the market, then maybe identifying some actual potential acquisitions.
Perfect. Let's talk about the deal sourcing. So how do you combine? So first of all, how does it work? Who pitches to you? And listening to this fireside chat, what should they pitch to you? Not to waste your time and to waste their time. So let's start from that first.
Yeah, so for deal sourcing, we kind of have a little bit of everything. There's already some established marketplaces out there and brokers, so we work with them. And then we do some outbound. So we have a couple of people who work for us who will go around contacting businesses that we think are a good fit. And then we get a lot of inbound because maybe, like you say, somebody hears me on a fireside chat like this, or they hear me on another podcast, they meet me somewhere, all of those things. So yeah, I mean, we kind of source deals from everywhere. I think it's one of our advantages. In terms of what is a good fit for us, we're really looking for something in the 1 to 3 million EBITDA range. Could be a bit lower, could be a bit higher if it makes sense. We'd go lower if it already has a general manager that's coming with the business. We'd go higher if it made sense and it was a good fit for some of our other things. We wouldn't necessarily want to buy a business that's larger than anything else we own if we didn't necessarily have any presence in that space, because it's a bit of a risk there. And so in terms of the types of businesses, we do well with agencies. We do okay with software. We have digital products businesses like online courses or ebooks. We do well with newsletters. We do well with some content type businesses. But really, we tend to not dabble too much in e-commerce. It tends to be a bit too cash intensive for us. But yeah, apart from that, it needs to be not too reliant on the founder, because most of the time when we're buying a business, the founder wants to leave and move on to something new. So there's a lot of founders who think they have a business until they try and sell it, and they realize that there's no way anybody can buy it because they just can't take over that business and have its revenues maintained. And so, yeah, if we can get past all of those things, then we'll pretty much consider anything. And then it just comes down to whether or not we think it's a good business.
So when you started the company, did you have anything in mind in terms of the synergies between the companies you're going to acquire in terms of clients, in terms of cost, in terms of the market that is available?
Initially, it was more about cost saving, like economies of scale, and less about, say, the ability to cross promote to one another. And then over time, we realized that cross promotion opportunities are useful as well. But a lot of the synergies and the economies of scale and so on, those things are really nice to have. They're kind of bonus things, but they can't make or break the success of an acquisition. So synergy is not the core strategy. I think, maybe you could buy a bad business just because you see synergies and it ends up destroying value, or you could buy a good business that has zero synergies and it just creates a ton of value. So we look at those things, but it's not like the core. It's not the core thesis.
Maybe let me ask the question from another angle. You talked about ebook, you talked about e-commerce, so a newsletter and so on. Do you have in mind to create a group around 3, 4, 5 ebooks provider, for example? Or do you see those companies operating independent from each other? And that's how you see it for the future?
It's a little bit of both. So, for example, we have one course which is kind of like a online career creation course, or like a BizOp course, teaches people how to build a career for themselves online doing a certain thing. So there's a ton of different courses that we could get where it's like, okay, this course teaches you maybe how to become a freelancer, or how to become a successful graphic designer, or how to build your own business, how to buy a business, how to, all of these different things. And they're all going to be specific to one kind of one solution. But if we bought 10 of those different courses, then now the audiences you can definitely cross promote to the audiences, and you can almost create a kind of all access pass where people can just they can buy. Maybe they've bought one of your courses, and you say, hey, if you pay double, you can get access to 10 courses or something like that. And then would they be run separately, or would they be run by one or two kind of portfolio managers? That's a harder question. We'd have to look at each individual business as it comes, and then maybe there's a case to be made for merging them. Maybe it makes sense to run them separately and have that kind of back end overlap. But those kinds of things are something we're doing. So it's not like OnFolio itself is one big roll-up with a ton of synergy, but maybe we have some mini roll-ups within the portfolio.
But you haven't thought about branding. So, for example, you haven't thought, I don't know, OnFolio Holdings courses, OnFolio Holding ebooks.
We have with our WordPress plugins. So we have acquired 2 WordPress plugins, and we're likely to acquire hopefully many more. And there is a lot to be said for building a reputation as a well-known development shop. And so we created the subsidiary WP Folio, so kind of WordPress OnFolio, WP Folio. And then, all of our WordPress stuff will be held under that same brand. So where it makes sense, we'll do that kind of thing for sure.
And is this the best way to present yourself to the market in the future? Because you're listed on the NASDAQ. So what does the market say about this?
I think the market just wants to see that we we thought things through and that they make sense, and that we are operating the best we can and compounding returns the best we can. I think the market's always going to have a different opinion about should we do this, should we do that, should we be one roll up, should we be a conglomerate, and I think really most of the time people have opinions, but they don't necessarily know what's going to work best. And so what we do is share our expertise and our rationale behind things, and many people will get on board with that and others may disagree, but it's about making sure the results speak for themselves.
And what kind of questions do you get from the market, from analysts, from investors?
I guess it depends on what recent news there's been, but usually right now people are trying to kind of understand our fixed costs because we're buying profitable businesses, but we ourselves aren't profitable. And that's because we have the high fixed costs of being a NASDAQ company, and we've acquired enough profit to account for, say, 70% of that. So once we've acquired enough to account for 100% of that, then we'll be profitable, or 110%, then we'll be profitable. And so a lot of the time the conversation is around, okay, what are the fixed costs? Like, are the businesses that you've acquired to date actually profitable? Because we have consolidated financials, so it can be a little bit obscure or a little bit difficult for people to necessarily understand what is going on inside there. And then, people also ask us about our philosophy and what's the long-term plan. Do we plan to hold these businesses long-term? Do we plan to sell them to PE? Do we have an opportunity in any of our businesses to create float? So there's a wide range of things, but I think because we are new and small and to some extent unproven, I think most of the questions just come down to, are you actually any good at what you're doing? And, what are the catalysts in the future, and what does the path to profitability look like?
And what is the advantage of being listed versus being private? Is that the visibility or the access to capital?
It's kind of everything. Visibility has been huge for us. Access to capital, it's a tough time to try and raise capital, so it's hard to know whether we've got more access than if we were private. We do have more access than if we were private, but it's hard to know the exact kind of tangibility of that. But also it's easier to recruit people to become business managers for our acquisitions. It's easier to incentivize those people with say stock options or bonuses. And it's also a lot easier to do acquisitions, especially as we have a preferred share out right now, which comes with a dividend. And so when we're making offers to founders, we could say, if we were a private company, let's say there's a business and it's worth $5 million. If we were a private company, we'd probably have to pay maybe $4 million up front, and then the remaining $1 million maybe 1 year later. But as a public company, we can say, how about we pay $2 million up front and give you $2 million in preferred shares, which is great for us because we never have to pay them back. And then we can give you $1 million as, like, let's say a 2-year earnout or a seller note or something like that. And sellers are much, much, much more likely to take that offer because we're a publicly traded company. So, there's a lot of advantages, basically.
And you're not worried about dilution in this case?
No, because we're offering preferred shares rather than common shares. So there's no dilution to the common there.
Perfect. The structure that you have in mind, that you have right now, and the structure that you have in mind for the future, you talked about selling, or the question around selling the businesses or potentially float them. What do you have in mind?
I think the ideal scenario for us would be to just hold the businesses forever, build up those retained earnings, and then use those earnings to acquire more companies and just rinse and repeat that way. But there's going to be there's probably going to be times where it makes sense to sell a business. And we've spoken about doing these mini roll-ups within our portfolio. So there'll probably be a time where, let's say, we've acquired 5 or 6 similar businesses, we've improved them, and maybe we acquired them all at 4 times earnings, and a PE firm comes in and offers us 7 times earnings for them. We would consider selling it, because then we can take those 7 times earnings and buy more businesses for 4 times and rinse and repeat that way. So the long-term strategy really is buy and hold and compound the earnings. But I think at any given time, nothing's going to be off the table, and it's just a decision that makes sense. Maybe we start to spin stuff out into another publicly traded company. It just really depends on what we think is the best decision for those businesses and for Onfolio shareholders at any given time.
What is the current shareholder structure?
Management owns about 30%, and the rest is publicly traded. There are some 6 million warrants out there. So we've got about fully diluted about 12 million shares. So 6 million of those are in warrants from the IPO investors, and there's a float of about 5 million currently trading. So pretty tightly held stock.
Thank you. So talking about describing the business, if you were to describe Onfolio Holdings now and Onfolio Holdings in 5 years' time, where would that be?
Probably 10 times the revenue. It's hard to make a prediction about revenue, because we acquire based on EBITDA. So we could acquire, say, 10 million in EBITDA, and that could bring 20 million revenue, or it could bring 100 million revenue. But I think we'll probably be 10 times the size in 5 years. Hopefully significantly larger market cap as well. And I think we'll have proven that what we're doing is working. We'll have several of these roll-ups quite well established. And like you said earlier, we'll have some of our acquisitions making acquisitions. And we'll, hopefully 5 years from now, a much cheaper cost of capital as well. And so I think the snowball will be in effect, and the flywheel will be turning.
Perfect. So let's talk about technologies. So you talked about a little bit what are the sectors that you are investing in, but technology is changing rapidly. What are the sectors that you feel are mostly affected by these technology changes, based on the portfolio company that you have?
I think content creation is the biggest one, because for example, Content Elect, one of our portfolio companies, it creates content for people. And I think the content side of the business is decreasing while some of the other side of the businesses are increasing. And I think its revenue is up like 10% year over year. So the business itself is good, but certain parts of it, AI will be more harmful. But then there's also positives as well. Some of our other businesses have been able to improve their margins by using AI instead of using people. And most of our other businesses have really been unaffected from a high level revenue kind of way, and it's more about efficiency. So you're able to work faster, you're able to maybe get more insights, you're able to just produce more things yourself as well. So maybe you wanted something created like a PowerPoint or a small text video or something, which is something that kind of within the day-to-day of our businesses happens quite a lot. And before, maybe it needs 3 people and 2 weeks of back and forth. And when people are maybe on different time zones and things like that, it can become quite inefficient. And then, whereas now, you can probably just do it yourself by interacting with technology and going back and forth, and get something that's probably 99% as good as what you would get working with a professional. but so much faster. And so those things, that kind of efficiency is going to take time to show up in top line revenue or in bottom line. Those are the things we've seen. I do think some businesses, they're going to have their lunch eaten by AI, but hopefully, touch wood, none of the ones that we've acquired, and we actually see more opportunity than risk, just in the way that we can develop tools or new software a lot more easily and cheaply than we could before.
But staying on the content part and talking about the improvement from a technological point of view and AI, do you think that the people, because in the content industry, a lot of people are traditional content creator, will they be able to reconvert themselves? First, the people that are working for your portfolio companies, will they be able to reconvert themselves? And the third question is, do you have enough developers that you can hire, because there is a lot in the market, but maybe not the right skill?
So I think the first one, I think the good thing about AI, and especially since ChatGPT came out, I guess about a year ago, it's so accessible, and it's because of the human language element, like the plain language element, rather than code and stuff that takes a long time to learn. I think it's very easy for anybody to reskill. Of course, it takes time, and I think the biggest people most people face is reluctance. There's people that are just gonna lose their jobs because of their unwillingness to embrace the change, which is always the case whenever there's like a new big technology out there. But I think if somebody wants to reskill, ironically, AI is going to make it faster. But even if they don't want to reskill into something AI related, like I don't think authors of books or writers or novelists necessarily want to reskill to being like a prompt engineer, because it's when you've got your identity wrapped up in being an author, you don't really want to suddenly be like, I just type instructions to AI. But if some author finds that they're being threatened by AI, then I think if they really wanted to pivot into something new, it's probably easier than ever to do that. Of course, maybe they don't want to because they love being an author, so then they can embrace AI and actually become more prolific, because if you decide to use AI to start churning out content, it's probably just going to be a bit rubbish. But if you're an author who needs to think about, how can I structure this chapter? How can I structure this entire book? I've got some ideas. How can I flesh them out? Then AI can actually really bring you to life there. And then, in terms of our portfolio companies, I think the advantage that small online businesses like ours have is they're agile. They're able to change quite quickly. Most of our employees or contractors are really embracing AI already and sharing different things amongst themselves. And so, for them, it's fine. They're not really going to be an issue. And then, what's the third one again? I forgot what
the third question is about the talent, and maybe across all the portfolio companies, is there a shortage of talent? Because there's lots of demand, but is the supply enough?
We haven't run into that issue yet, but we operate with small teams, so we don't need, say, hundreds of engineers or developers. We maybe need 5. So we don't have that issue. But I do think there's kind of globally, excuse me. I think globally there's probably going to be more demand than supply initially, sure, but I think people are coming up to speed quite quickly, and again, AI is so accessible that pretty much anybody who can speak English now can be an AI developer. or not even English, but any of the language, a natural language. It doesn't have to be code, and so it's pretty interesting to see how that's evolving.
You talked earlier about being listed gives you more visibility, which means it's easier to hire. How did you see that?
Well, we see it everywhere, really. So when we post a job application on somewhere as simple as LinkedIn, the quality of people applying compared to a year ago before we were public is significantly higher. And then when we're negotiating contracts with people we want to hire, they're a lot more willing to take kind of like a lower salary and more upside. And those people, those types of people are a lot more excited to get on board, and because they see what we're building, and so there's a little bit of prestige as well, but it's more about we're doing something fairly novel in a good way, and so that attracts people. And also, I get people reach out to me all the time, people who maybe have followed me for a few years, or people who have only just discovered Onfolio and they like what we're doing. So it's not just about hiring; it's also about recruitment, and kind of, again, visibility for candidates. That is really, I mean, we expected it to be the case, but it's actually kind of surprised us at how quickly it was the case.
What is the difference for someone looking to work for you between working for you and for a private equity firm? Similar jobs, if you like, but different contexts.
I think there's some overlap. I think we focus more on just being able to operate an online business. And so it's not really about whether you're working for a public company or a private equity company. I think it's just about, are you a fit for the business? And so private equity probably attracts more finance oriented, spreadsheet M&A type people, whereas we're more attractive to people who just really want to become part of a big holding company which is building something long term. But we're able to incentivize people in similar ways. And there are some other public companies out there, such as, say, TransDigm, which calls itself private equity in the public markets. And that's because of the way they incentivize their managers to give them kind of private equity style compensation. And so it's a little bit too early for us to kind of go fully in that direction, but that's something that we're planning to explore as well.
Okay. One final question as we are approaching the end of the discussion. You talked about the aspiration for Onfolio and the size and so on. What about your personal aspiration?
Well, my personal aspiration within Onfolio, I mean, when I started Onfolio, I had already exited another small business before, not a big, I don't need to work again exit, but enough to scratch that itch. And so I was looking to build something that I could dedicate the rest of my life to. So 20 years, 30 years. And so my plan is to just keep doing what I'm doing in Onfolio for a very long time. And outside of the company, it's kind of hard to think of life outside of the company, but I have 2 children, a 4-year-old and a nearly 1-year-old. So it's really about, I'm kind of growing a company and growing a family at the same time. And so making sure that both those things grow to be as healthy and enjoyable as possible. Those are really my 2 main aspirations, at the moment.
Perfect. Dom, thank you very much for your insight, and thanks everyone for listening.
Yeah, thanks for having me.